everyone. Welcome to part 2 of our discussion of gains and losses. Remember, we are still working on the idea of basis. We talked about basis when you purchase it. We talked about capital additions and capital recoveries. We've talked about basis when you inherit it and when you receive it as a gift. So we're still in that, and now we're talking about what is our basis when we convert property, usually from non-business or personal use to business. That's what we're talking about typically here. So the key thing is what happens when you convert it. What's your basis? So if you convert it and the fair market value is greater than the adjusted basis, then there's no loss at the time of conversion. We just start from that initial basis and we add all capital additions and minus all capital recoveries. Now, careful, if this is being converted from personal, which is typical, to business, then at the time, for the time that it is personal, there are no capital recoveries because no depreciation is allowed. Capital additions can happen. You can make improvements to the property, but there is no, most capital recoveries are only for business property. So that would not apply to the time it was personal use. So that is the formula, and you don't have to worry about getting an extra loss from the decline in value. So the idea is, if you bought a computer a couple years ago and then now decide to use it in your business, while you may have paid $1,000 for it, it's certainly not worth that when you convert it to business use. And so you do not get the benefit of that basis at what you originally paid for it. You have to only consider the fair market value at the time of conversion. Okay? So only if the fair value is higher, which would be very rare on most personal property, would you be able to consider the things that happened before. So, convert vacation home to rental property, purchased the home for $80,000, made $10,000, and it was valued at $95,000, converted to rental property. Since the fair value is greater than the adjusted basis, okay, his basis in the home when he goes to sell it is the full $80,000 plus the improvements. All right. However, if it is less than, like we talked about with the computer, then it looks a lot like when we dealt with our gifted properties. We have a loss basis and we have gain basis. And the loss basis is what we're going to use for depreciation too, by the way. But that loss basis, okay, ignores pre-conversion additions and recoveries. So, fair market value at conversion, as if it was bought new then, to use in plus anything after conversion that happens, minus any capital recoveries after conversion. So it's kind of like you start over at the conversion date if the fair value is lower than the original cost. Okay? So, convert the vacation to rental property, purchase it for $80,000, made $10,000 of improvements. So his basis is $90,000, but at the time of conversion, it was valued at only $76,000. So he's going to be using the $76,000 as his loss basis. And any adjustments after that will affect it. Any depreciation or improvements after the conversion will count. But anything prior to that doesn't count. So, but remember that if it's Gain basis is the value with all additions and all recoveries. So in this example, Dale's loss basis is $76,000. And right now, assuming no additional depreciation or additions, his gain basis is $90,000. So if he sold it for less than 76, he would have a loss for the difference. If he sold it for more than 90, he'd have a gain for the additional. And if he sells it in between, he has no gain or loss, just like with gifted properties. There's that middle part where there's no gain or loss. Okay, there's your summary. Stock splits, pretty simple. Okay, you just take the basis of the original and split it amongst all of the new shares. So, 2-for-1 stock split, the $5,000 basis, $50 a share before. After this split, your basis total is $5,000. Per share is now $25 because you have twice as many shares. Stock dividends, same thing. If you're given an option of cash, it is taxable. That is almost never the case. Most of the time, it is not. The option of cash, for that very reason, is not taxable, and you spread it amongst all of the shares. Now, the general idea is if you realize a gain or a loss, okay, gains are always recognized unless there is specific in the tax law a reason not to. Losses are recognized only on business property or investment property. Okay, so there's some exception to these, and that's what we're going to spend some significant time here looking at the difference, the various exceptions to this general rule. Casualty or theft losses we dealt with back in, that's an itemized deduction. That's on personal use property. So we're going to wash sales. All right. The idea is that you sell a stock for less than you paid for it, you get to take a loss. However, if you repurchase substantially identical securities 30 days before or after, so there's a 61-day window, the day you sold it, okay, and the 30 days before or after, you cannot rebuy those same shares, or you're going to be able to recognize a loss. So here's an example. We bought 1,000 shares for $8,000. Well, yeah, and then another 400 on April 4th. We sold 1,000 shares we purchased in 2001. Okay. Realized loss, picked the 8,000. We sold at 5,600. Okay, bought for 8,000. Okay. However, but since we purchased another 400 shares within the 61-day window, okay, the part that has to do with that is not allowed. So 40% is disallowed. The other 60% is allowed. Okay, so you can split it up that way. The basis in the shares involved in the wash sale are increased by the disallowed loss. So that adds to the basis so that you don't have penalized twice for that. So your basis in these shares goes up by the 960. That means our loss on those shares, if we ever do a legitimate sale later, will be higher. So it's kind of a postponing the loss. Sales between related parties, that you sell to your brother, sister, somebody that you're related to. We're going to have a problem with that. The IRS says that might be a way for you to create a loss that didn't really exist. So we are not allowed to recognize that loss. Brother takes the basis of 5,000. Later sells for 12. He can use the realized loss Harriet had that could not use in the past, okay, to reduce his realized gain his gain was 7. He gets to use 4,000 that Harriet didn't get to use to reduce his recognized gain to 3,000. Okay, same situation. Okay, the realized loss is 4,000. All of it gets not recognized. New basis. She has a realized gain of 3,000. She can use the 4,000 her brother couldn't use, but cannot use all of it because she cannot have a loss. So she only gets to use 3,000 of it to make it a 0, but she can't have a loss. Okay, special stock that has gains that can be excluded if you hold it for more than 5 years. All right, we're not going to get into details about what Section 1202 stock is, but it's important for small businesses. They can have gains that are not recognized. Like-kind exchanges. Now I have a separate podcast on this, but we do want to go through these. The like-kind rules are mandatory. You have to abide by them. You cannot choose to it. Okay? Remember that the basis is the like-kind property whatever you receive is increased by the loss or decreased by the gain. So there's the formula. So the first thing we need to know is that if there is a like-kind exchange, what does it mean to be like-kind? Now, real property is pretty broad. You can exchange for just about any other real property. But personal property has got to be nearly identical. So that doesn't happen very often. Real property is where most of these like-kind exchanges happen. And remember, inventory, foreign property, securities, and partnership interests can never be used. You never use these rules for those properties. So there's some ideas of what would need to be nearly identical. Okay, you'd have to be something within the same class. All right. Now, if there is a situation where you're exchanging properties that are like-kind, but somebody has to pay the other cash or assume a mortgage or something to make it work out, because the properties that you're exchanging are not exactly the same value. So the amount that you give that's another type of asset is called boot. If you receive boot, you're going to realize gain to the extent that you received boot. If you gave boot, okay, is only going to result in a gain if the value of the property you gave, the boot you gave, is different than what your basis is in it. If the boot is cash or mortgage assumption, then there will never be gain or loss on giving boot, only on receiving boot. So here's an example. Exchange land for $50,000. We're for Jane's land 40,000. Even though exchange, we pay 10,000 cash. That makes it even. Okay. Sam's basis is 36. Jane's basis. Let's look at the tax consequence for Sam. He realizes he gets 50. His basis is 36. He realizes 14. His recognized is only the amount of the cash or boot received. His new basis is land he got minus the postponed gain. Jane, she receives $50,000 worth of land. Her basis is the 10 she gave exchange plus the 65 basis in her land. She's got a loss of $25,000. These are mandatory. You cannot not recognize. Not deal with that. So there's no recognized loss because she gave boot. So there's no recognized loss or gain if you give boot. And then her basis in the new land is fair value of what she received plus the postponed loss in this case. Subtract the postponed gain, add postponed loss. Second example, realized she received no boot, so she has no recognized gain. So her basis is the fair value minus the 14 postponed gain. Earl recognized the gain of 3,000 because all of his realized gain is 3,000, and he received cash of 10,000. So his recognized gain can never be more than his realized gain, so it is all of it because the cash received is more than the 3,000 realized gain. And because he has no postponed gain, his fair value of the new land is also his basis in the new land. All right, so for part 3, we'll do sale of principal residence, a couple other wrap-ups to complete.